Getting a mortgage can be quite difficult, but by the end of this video, you're going to learn the 5 ways to increase your chances of getting approved for a mortgage. What's going on, guys? Welcome back to the channel. My name is Nav, and if you're new here, we talk about personal finance, investing, entrepreneurship, and a whole lot more. So make sure you guys smash that subscribe button because I upload twice a week and you definitely don't want to miss out. You see, guys, applying for a mortgage can be very stressful, and it's probably the hardest part when purchasing a home. Not only it's difficult and stressful, but it's actually the first thing that you should be doing when searching for a property. The last thing you want to do is walk into your dream home one day, being able to put an offer on it and then get declined when it comes to financing. Now, I did want to mention, guys, that I am not a mortgage broker. I am a real estate agent, and a big part of my job is to actually work along with the mortgage brokers. Of course, over the past several years, I've gotten many of my clients approved when working with specific mortgage brokers, and these are the exact things that mortgage brokers are going to ask when you apply for a mortgage. All right, guys, so let's get straight into it. The first thing the banks are going to want to see is consistent income. And right off the bat, one of the main questions in your mortgage application is going to be exactly who your employer is and how long you've been working with them. As long as you've been working with the same employer for more than 2 years, this is a big green light for the mortgage application. Now, we're currently in a global pandemic while I'm making this video, so another thing that mortgage lenders have added to the application is a pay stub that they're going to require from the past 2 to 4 weeks. You see, the numbers of unemployment have dramatically increased, and the only way for you to prove that you've been working with the same employer for the past 2 years is to also show them proof that you have a pay stub from the past 2 to 4 weeks. So don't feel like you're getting targeted by the mortgage brokers and they just want to shut you down, guys. This is specifically just for their safety because they're lending you a lot of money. Quite self-explanatory, guys. Consistent income is what's going to pay your bills. So the mortgage lenders are definitely going to want to know how much money you're making monthly, after taxes, before taxes, and what kind of expenses you have throughout your month. And after clarifying your income, your employer, and how much money you'll be left with a potential mortgage, the next part they're going to inquire about is your down payment. Your down payment is the cash that you're willing to put down on the specific property. Now, usually speaking, you can get away with a 10% down payment or even a 5% down payment, depending on how strong your mortgage application is. Of course, the larger the down payment you have, the lower your mortgage payments will be in the future. Your down payment will also affect the interest rate that the bank offers you at the specific time. Now, if you do put a 5% down payment, the lenders would consider you a higher risk than if you were to put maybe 10 to 15% down. So in conclusion, they would charge you more interest. Now, if you're buying a property for your own personal use, then typically speaking, you can put a lot lower as a down payment. But guys, this is very important because the moment the banks find out that you're buying a property as an investment and you're gonna rent it out to generate rental income, that's when they're gonna ask for at least 20%. Now, don't get me wrong, guys, buying a rental property is not a bad thing in the eyes of a mortgage lender. But the moment they find out that you're buying a property to build passive income, they're gonna want a piece of that pie as well. And because you're buying the property as a rental property, they're not only gonna require a larger down payment, but they're also gonna charge you more interest. That means if you're buying a property for your primary residence, you might get an interest rate around 2.5%. But as soon as the banks find out it's for a rental property, they might charge you up to 4.5%. Another reason why banks will require 20% down payment when buying a rental property is because that will reduce competition. And guys, if we were all able to buy a rental property with 5% down, then it would be a piece of cake and we would all have like 10 of them. So it does make sense, but you need to understand why exactly the banks require 20%. Imagine we were able to buy rental properties for 5%. I mean, think about it. If we were about to buy a rental property with 20% down, we could potentially buy 4 rental properties putting 5% down in each of them. So that's exactly why the banks are going to require at least 20%. Now, aside from the mortgage lenders, another reason why you should be okay with the 20% down payment is in today's pricing, that's actually the only way you'd potentially break even or make a profit if you rented out the property. For example, right now in Toronto, if you were to buy a rental property with 5% down, and let's just say that was possible, you would be very negative monthly. And the last thing you want, guys, is to buy a rental property and pay money out of your pocket to keep up with the rental property. The whole point of a rental property is to make you passive income. And the only way to make that passive income is to put a 20% down payment or higher. After looking at your income and your down payment, the next thing the lenders are going to look at is your credit score. Your credit score is one of the most important things when building a financial portfolio. Now, if you guys haven't seen my previous video uploaded about my credit score hacks, I'll leave that in the description down below, or also right above me, somewhere over here or here. I highly suggest watching that video right after this one because it'll give you the exact ways to increase your credit score in a very short period of time. So back to your credit score. Now, typically speaking, people always say that you need a minimum of 700 credit score to get approved for a mortgage. Now, this may or may not be true, and let me explain to you why. I've mentioned this in my previous videos that your credit score pretty much identifies you as a person when the banks take a look at your credit application. Of course, if your credit score is much higher, then the chances of you getting approved are also much higher. But if your credit score is much lower, the chances of you getting approved might drop, but the only way to resolve this is to either increase your down payment or pay a higher interest. Again, this all comes back to risk evaluation when it comes to the mortgage lenders. So whether you're buying a property for yourself or a rental property or anything in life, I always suggest to monitor your credit score and make sure that it's always at the highest it could be. Keeping your credit score over 700 should always be a goal for yourself, and of course, the higher the better. Now, hypothetically speaking, guys, the income portion of buying a property is likely to be the most difficult part when purchasing a home. So you have the down payment and you have the credit score, but maybe the income is just not where it should be. Well, then the only way a mortgage lender will allow you to get around this is to work with a guarantor. Now, working with a guarantor, it pretty much means that someone is gonna guarantee that you will make these payments. They're also gonna be on the title of the property, and this can be your mother, your father, or even your guardian. It doesn't matter who it is, they're pretty much also going to be liable for the property as well. And guys, it's not a bad thing to work with a guarantor. I mean, if you need to, I highly recommend doing so. If it's the only way that you can get a property under your name, why not? Just do it. As long as you can trust each other, this can help out your mortgage application big time. And the reason why is because now your income, your credit score, and your down payment is looked out between two different people. This will strengthen your mortgage application big time, and it's actually one of the most popular ways to get approved for your first property. I've worked with many clients where their father or mother have been the guarantor on the property. It's nothing to be ashamed of, and it's actually one of the best ways to get started in real estate investing. The chances of you getting approved with a guarantor is much higher, and it can also reduce the interest payments on the property. And like I mentioned before, guys, this is nothing to be ashamed about. People get guarantors all the time. You would be very, very surprised. I mean, it's one of the most common ways to get a mortgage application from declined over to approved. And the final way, guys, to get your mortgage applications approved is to possibly work with a B lender. The reason why I say this is that when you do run a mortgage application, A lenders are typically the ones you want to go for first. And if you're not familiar with what an A lender is or a B lender, an A lender is a bank that you would possibly see on the streets. I mean, it's the most mainstream banks. For example, if you live in Canada, it could be RBC, Scotiabank, TD Bank, etc. B lenders, on the other hand, are private banks. Now keep in mind, guys, of course, when you work with an A lender, the interest rate is going to be a lot lower, but they have a lot more rules and protocols to follow. Whereas if when you work with a B lender, you have a higher chance of getting approved, but on the trade-off is that you may potentially pay a higher interest. And just to mention, guys, a lot of people use B lenders. It's quite popular. If anything, I feel as if it's more popular using a B lender than an A lender because A lenders tend to be so strict. And if you ever do get approved with an A lender but decide to buy a second property and the A lender decides to not approve you because you already own a property, a B lender, again, is another great way to get your hands on a second property. A lot of viewers on my channel are ranging from the age of 18 to 35. So if you are in that age group, guys, I hope I motivated you because a lot of people believe that buying a property is quite difficult. And let me tell you guys, it is, but you could definitely work it out. Another strategy that many people use when buying a property is using their partner, for example, on the title as well. Now, I'm not a relationship guru, guys, but again, if you do have a partner like a girlfriend or a boyfriend, it is another highly recommended strategy to use when buying a property. Now, again, I'm not a relationship guru. I'm just saying that if you believe that there's a future along with your partner and you guys have goals and you want to eventually buy a home, then this is definitely a very popular strategy because it might be a little bit more difficult when you're running the application under one person, but the moment it says two, it kind of just cuts the stress on the application by half. If you don't think you're ready for a mortgage right now, then I highly suggest looking into pre-construction. Pre-construction is a great way to get your hands on your first property, and it's pretty much buying a property before it's built. Now, typically speaking, builders would require a 20% down payment, which is a lot more than when you would put on a resale property because you could possibly buy one for 5 to 10%. But builders offer deposit structures which could really ease your buying process, and that way you're not dumping 20% out of your pocket right away, you're breaking it down within a couple of years. And there you have it, guys. I hope I shed some light in your mortgage application journey. If you guys enjoyed this video, please smash that like button and comment down below what you've learned throughout this video. With that being said, guys, my name is Nav. Thank you so much for watching, and I'll see you guys in the next video.